behalf of Growth 91 and Future Unicorn, I'm very happy to welcome you all to this webinar. Today, we'll not just talk about ESOPs, cap tables. We'll also see some real life calculations that we need to do, and some of the most confusing topics, but yet most interesting because equity is a real currency for startups. It is not the cash you generate, but the equity that you have, and how you manage it in the early days can really, shape your fundraising journey, can uh, establish a investor trust. And also, if you can give some equity to your team members, then it can really enhance your team motivation as well. So we'll keep this session very practical, no heavy jargons, only founder-focused insights and what I have learned during my journey. I'll share that as well. And also we have some amazing guests with us as well, who will be sharing their insights. We have two amazing guests with us, Mr. Sanjay Sarda. So he's a VC and he has a lot of experience, invested in 88 plus companies till now. And also we have Mr. Vicky Jain from the founder's perspective, and we'll have a proper introduction of them later during this session. And the goal is very simple. By the end of the session, you should have clarity and clear understanding uh, to what mistakes, common mistakes to avoid, and that many startups make. So I'll just quickly share my screen and start off with the presentation as well. Then we can have Vicky and some of his insights as well. So I'll just share my screen. So yeah. So yeah, welcome all to the masterclass, and let's get started. So yeah, about us, we are Growth 91. So we have backed 88 startups so far with consistent success stories. Over 2,000 investors on Future Unicorn platform. We have 2,068 investors to be precise. We also have a SEBI-registered Cat 1 angel fund. So a lot of things can be enabled for founders from there. And we have Future Unicorn where we have 2,000 registered investors. We enable hiring, GTM, and all the collabs and partnerships that startups are looking at. Like one startup can partner with other startup. This is a closed ecosystem where one startup, someone who is looking for a HRMS can partner with Uknowva. Someone looking for a uh, carbon credit solution, they can partner with eco rating. So this is a closed ecosystem where one startup can help the other startups in this way. So we are not just a listing platform, we are acting like a active co-founder. And we also host this webinars and all these sessions. So I'll just walk you through Growth 91 platform. Here is our website, about us, what we do, and what startups we have back. We have two platforms. One is the deals page, where we have all the active deals that we are investing in live on this platform. There are 4 live deals with us. We are investing in Stoom, Good Melts, Extra Mile Play, The Elephant. Anyone who is looking to invest into startup, they can just log in into the website, see all the details like the about us description, market overview, highlights, investor presentation, deal terms, company details, some of the documents that we prepare on the startups we have about the company, about the investment, and they can just make their call to whether to invest in the startup or not. And below you can see all the completed deals that we have done. So we have invested in 88 plus startups till now, and with a lot of successful case studies, like 7 plus uh, successful exits we have already got. Then there is Future Unicorn, which is a platform for all the early stage founders, from idea stage, idea validation, and all the stages, to just create a closed community of founders where one partner can one startup can interact and collaborate with other partners. And yeah, so here is, let's take an example of Unova. Here is their about us description, their market overview, highlights, which are the traction points, some of the team, and investor presentation, videos. Contact us. Anyone who is interested to partner with the company, they can just click on I am interested. Whether they can explore collaboration, they can just know more about the startup, or they can just submit their queries. So yeah, these are the things that we enable. And yeah, sorry for the disturbance. And So yeah, let's take an example, and let's invite Vicky to speak. So we also have Vicky Jain, founder and CEO of Uknowva, an AI-enabled HR tech platform for mid-sized companies. Uknowva today serves like around 3 lakh plus active users as of last I know, and 120 plus paying customers with a 93% retention rate. Vicky will share his founder journey, his key learnings, and all that can help all of us think bigger and build stronger. So welcome, Vicky. And
Thanks, Uttar.
yeah, so actually, first question would be when you started, how like can you share a bit about us about you?
Sure. So, something you've already covered with us, like of course, we are a SaaS-based HR tech platform currently serving, while 300,000 was when we started interaction with Growth 91, and today so we are 500,000. Just I think in the last 6 to 8 months, we've added almost more than
Uh,
200,000 users onto the platform. And
uh,
yeah, we're serving, we are complete made in India product. We are serving some of the global customers. We are actually competing with success factors, Oracle Fusion, and customers like Kotak Bank, IDFC First, and Delivery, video consultants, Reliance Retail, etc. These are all people who trust us and have been benefiting from the platform. We are a very lean team. In fact, that's what we strongly believe in. We are around now 100 at the moment and growing from, of course, from an employee standpoint also we are growing, but customer wise, we have a presence across now India, Middle East, and even Southeast Asia. Yeah, that's a quick background about us.
that is that's a great number actually. So Vicky, when you started, how did you structure your cap table, and what would you like if you were to do any differentiation, what would you do differently today?
Uh, so when we started, see, actually we started, there were three directors. We are a completely bootstrapped organization. So unlike an angel funded or a VC funded or even friends and family funded organizations, that cap table was very, very simple because we were three directors. Since we were all involved completely into the business operationally also, we had a very simple 33% split. And yes, when we actually added in the journey, there have been like even SIDB gave us a venture debt and then took 1% equity part of the PM Startup India campaign and all of that. But fairly, we have made the cap table very simple. In fact, this is my advice to everyone: you should keep it very simple uh, and not take investment, even maybe from the friends and family or anyone when it is not needed. Many times, this is what I have seen with other founders also. They have taken more money when it is not needed, and then they end up actually not getting good deals when it is actually needed. So that is how we structured it very simply. Then, of course, in the long run, we also, since employees were also an integral part of it, we carved out an ESOP pool and all of that. I think there are subsequent questions also to that, which I'll answer. But this is how we kept it very simple. And to answer the question, how would I do it differently? Uh, I personally think till date, all the people that I have met, be it my customers or potential investors or even strategic partners, they've all said, okay, it's a good, simple and good cap table. And I don't think I would have done anything better. Just probably I could have maybe avoided, or rather that's actually no SIDB norm, because we had given venture debt and still they took 1% equity kicker. If that could have been done better, that's what I just believe. But I don't think there's anything else that I can think of at the moment. Yeah, how could I have made it better?
Vicky, any common mistakes that you see in founders making to make cap table, or you at first starting our founder journey you have made, and you want to just guide the founders to how they can improve and what
See,
things they
I
can
have
improve
seen
on?
certain things. As I said, sometimes people take a lot of money when it is not needed, and then when actual money is needed. For example, you're not doing revenue. Okay, someone comes to you and says, okay, I'll give you 2 crores, you give me like, there are a bunch of new people, we give you 2 crores, you give us like 30% equity and all of that. And it is not needed also because you're still, bootstrapping and figuring out all the idea and all. So you should be very lean on that front. Don't take the money when it is not needed. It will end up. In fact, for that particular, startup we're talking about, they took the money. Then what happened is when they actually needed another, say the next round of funding, it was very difficult for them because they already had multiple people on the cap table. Plus, each of the founders, together were not making that 26% or 51% of the total equity that they should be owning, because these are all concerns of any investor who is going to invest in you, because what if the founders leave, then there should be some controlling and all of that. So no my advice would be, don't take money when it is not needed. uh, be very lean on that front. One more thing is, yes, people end up giving advisory equity unnecessarily. There have been umpteen number of times people have approached us, since we are in the HR tech space. So a lot of HR leaders have also approached us. Okay, okay, I can get you this much amount of business, and you should give me this much equity. That doesn't work, honestly, and you should not. Equity is very precious. You only have 100, no, in your lifetime of that journey. You should be very wise to give equity. If someone has not worked with you and still is wanting advisory with the promise of doing something for you, he's not the right person to give the equity. If he has done something, then you should do, or at least there should be some agreement. Okay, the disbursement of equity will be after milestones and not upfront. So that is one advice I
Correct.
like to give you. And I was advised for that. I'm fortunate to have such mentors, because in very initial stages, even a customer comes and you're not revenue generating, and a customer comes, I'll get you a crore ARR account. And you will do everything possible for that, even sell out like 10% equity for that. Don't do that. That's what I was advised. And I'm fortunate that we didn't do that.
So, Vicky, when you started, when was the time when you created the ESOP pool for the employees? Was it before the first round happened or after that? And how much you allocated? And what is the general, allocation percentage of ESOP pool? What things to keep in mind?
So as I said, we bootstrapped. So there was not much of funding rounds or multiple rounds that we went through. Uh, so but we made our ESOP pool almost. So as soon as my product market fit was reached, that people were accepting our product, that means it has ingredient, to scale. Now to scale, obviously you need very dedicated people, because you founders themselves, can make the company 0 to 1, but cannot make it 1 to 100. 0 to 1 journey is basically your product market fit has arrived and someone is paying you for your product. 1 to 100 journey is where you have to actually scale it. You will need more people, more professional people, people who are better than you. Like if you are a say a techie, someone who can do better sales than you is the right person to be hired in the team. Now, why would someone actually stick to your company while you might give them handsome salaries and all, which obviously every Indian startup is restricted, by the way. They do not have deep pockets, and I personally also believe they should not be having a lot of deep pockets that they end up giving extravagant salary. But yeah, what is in it for them? That is the ESOP. And we realized it as soon as the product market fit was achieved. In fact, we launched our product in 2016. We realized by 2018 that we are there. We started our ESOPs then. A 5 to 10% equity ESOP pool is what I would suggest. We started with 5,
Mm-hmm.
for our employees, and of course, it was also milestone based. Right? We ensured We do not give equity or ESOPs to anyone who has at least not worked with us for 2 years. Even if we hired a new guy, we used to put it in writing here, while we will give ESOPs, but you have to have a commitment of 2 years. So yeah, that's the answer to the question, Utkarsh. 5 to 10% is what you should actually carve out. At least 5% to start off, I would say.
Okay, one last question from my end. There is some question in the chat box as well. We'll take it.
So
One last question, Vicky. You are also part of Future Unicorn of Growth 91. So, what changes have you seen after onboarding onto Future Unicorn, and how would you like to brief to the founders that are here? Why should they register for such a listing platform?
So I would say it's a great platform to be or create awareness or be catch the eyeballs. Honestly, uh, as soon as we were listed on the Future Unicorns, of course we got a lot of credibility, not only from our or potential investors and all, but also customers, because there is someone else endorsing you. You yourself will always keep endorsing, okay, I'm a very good business. I'll make this a billion dollar company and all of that. But when someone else is endorsing you, that is what makes the difference. And it gives us a lot of visibility, awareness, and we were treated as a serious brand. Like I'll tell you, we onboarded some of the very big names recently, like a very large audit consulting firm, the fifth largest audit consulting firm, the leading newspaper in India, all of that. And I believe somewhere the trust level that these big enterprises need to have while signing up, growing organization like ours. These are all the factors that actually build their trust level, because we were listed in Future Unicorns. We were having a very, of course, that was one ingredient to it. We were also endorsed by our customers. We were also, listed on like Gartner and all. So these all actually helped us get that kind of trust level from our cus- existing as well as potential customers. So that's why I would say
Okay.
you should actually get yourself listed, try everything possible that can get you onto the list. It will definitely create credibility, not only in terms of current and potential investors, but also customers.
Great, great. So, would love some quick answers. There are few questions. When
So
to choose debt funding over equity?
uh, interesting. I would suggest, see, of course, everything has a cost of capital. Even if you take, while this is a myth, people think that when you take equity capital, it is coming at a zero cost, whereas it is not, because there is a cost of capital or an ROI attached to everything. So of course, debt cost of capital is very simple, the interest rate. But when it comes to equity, equity is the ROI the customers are expecting, or sorry, investors are expecting, plus that the thing that you will spend in raising that fund. Like for whoever is the banker will actually ask for their maybe 2-3% and other things. So you need to figure out, okay, which one is best for you. And I'll tell you one funda. If you are a profit making company, then you should have a mix of debt plus equity, or rather have more debt and less of equity infusion. But and you see a future also. Like currently, you may be profit making, but in the next say 1 year, you are confident that I will keep generating profits. Then it's fine to have a debt fund also to fund your future growth. But again, don't take it unnecessarily, because then you should not get into a debt trap. Or if you're not confident, or not, are you not on the path of profitability, then start with an equity fund, achieve your product market fit, achieve a profitability stage or a path to profitability, and then look for that. Best of the companies will have a mix of debt and equity funding. Take any big companies or any big corporates today, they have a mix of debt and equity. Utkarsh, you're on mute.
Vicky, I would like you to be on the call for a few more minutes because we
Sure, sure,
have one amazing guest with us as well.
sure.
So we also have Sanjay Sarda, sir. So actually, he is the co-founder and director at Growth 91. Sanjay sir, welcome. And a little bit about Growth 91, as I have covered earlier as well. Growth 91 has already invested in 88 plus companies from pre-seed to pre-series A, and is backed by Growth Sense, which is a SEBI-registered Cat 1 angel fund. And Sanjay sir is a IIT Kharagpur graduate with 30 plus years of experience. He has worked in India as well as US. He's known for his expertise in business strategies, governance, and founder support. And sir, welcome. Would love to hear from you some of the tips and some of the tips that you see or the common founder mistakes that happen in the cap table and with founder equity.
Sure, sure. Thank you, Utkarsh, for inviting. And hello, everyone. See, basically, when somebody starts a business, I mean, it starts with the idea, then you build a team, you take your friends along or your family along. So I'm more focused talking on early stage things. When you are a large company, then this question probably may not arise. So there are things you have to balance while deciding equity split. I mean, your emotions and your logic. So like sometimes one of your friend joins, you say, okay, let's start together. We'll have equity 50-50. That's a very common thing. People, two friends come and start the business.
Right.
Sometimes it is like there are four friends coming, 25% each, and everybody starts. But probably you don't give time to evaluate whose passion is what and who is in business for a how much long period. So these kind of things needs to be evaluated properly at the early stage. Probably it's better to take experts' advice or onboard some advisor, mentor, or somebody who will guide you on negotiating what should be the equity split between founders. That will help you in a longer run because we have seen some cases where people just start with like 50-50 equity and then after a year they come to understand one person is working, second is not aligned with the vision. Now, how to reach settle that equity, that becomes a problem, and the business goes in a difficult phase. So many times you can have different structure, like have some equity aligned with which is unconditional, and then some equity you can define based on your performance. So I mean, couple of structures. I mean, I'll give you example like in what we did. I mean, there I have structured a deal with two founders. So who will be a long race person and who will be a short? Both were saying, I will do a great work. What we did, I mean, we gave some 10% equity to them both equal. So remaining 80% was designed to be allocated over a period of 3 years. So whoever is working what,
Okay.
whoever is contributing every month on month, and that equities will be released to each founder, and within 3 years time, they will have a right set of equity. It could be 50-50, it could be 10-90 or 90-10.
Right.
It could be anything, but both will be happy and satisfied, and the business will be stable and it will grow. That was just one example. So you have to do a lot of balance between emotion, logic, and take experts' advice while deciding on equity. Second important thing is when husband wife start a business, you just give 50-50. That actually does not work. You decide who is actually leading the business and who is supporting the business and have the equity split accordingly. And of course, don't take anything as a standard rule. Every business is independent. Every idea is unique. You need to honor different concepts and ideas. So equity will be allocated based on demand, supply, need, and what's the value one brings in.
Right, sir. Great to know. Actually, there is a lot of confusion these days on how to split founder equity. Sir, one more confusion I see in a lot of founders in while raising their first round. Like, how should they choose if they are choosing an angel investor? How should they choose how much equity to give? Also, some investors ask for some mentorship equity. So how should founder deal with that, and how they can keep the cap table clean? Would
See,
love some
basically,
guidance in that.
got it. Yeah, yeah. So basically, see, very simple. Equity is very expensive. Equity is the most precious thing for a company. So technically, giving equity for money should be the last thing. So give at an early stage, I'm talking. So better when you give equity to your advisor or mentor or somebody who is helping you, just evaluate that you are not in a position to pay the cash, what that person will come with. And against that, you are paying the equity. So that time, this is one tool a startup has to onboard a person. For example, let's say everybody knows Sundar Pichai of Google. Everybody probably want him on the board.
Right.
But any startup, tell me whether he's in a position to pay his salary, early stage startup, or maybe pay him for a couple of hours of his time. We may not be able to pay. So that time equity has to be given to at least try to attract good people at the early stage. So it's definitely advisable to give equity to right set of mentors and advisors for getting their value or valuable inputs or their association. And naturally, how you take it, that all depends on you as a founder, how you interact, how you extract the knowledge from the expert. That all depends from person to person.
Right, sir. Sir, any guidance on Future Unicorn as well, like how we have planned to, or like how we have planned to help the founders at Future Unicorn, and what were the vision behind Future Unicorn?
See, I have come from an entrepreneurial background. I mean, I started my first venture when I was in first standard at the age of 6. And since then, doing a lot of new things every day. So, understand what is the value and what are the challenges of the entrepreneur. Talking in current scenario, I mean, a very basic challenge what a founder face. You start a company, you approach your advisor, investors, write an email, connect them on LinkedIn or anywhere else, and try to connect, try to pitch them. But many times investors don't have time, the right set of investors where you want to approach. So you follow up again, you follow up third time, for third or fourth follow up, somebody says, okay, I will see your pitch. So when he sees your pitch, which you sent to him before 3 months, probably that has changed altogether, because startup you change every day in the early stage. You are developing, growing every day. So the basic idea is whenever you get that one small opportunity of 10 seconds or 30 minutes, 15 seconds or 1 minute, when somebody is ready to look at you, that time you should be ready with your latest live information. That's what Future Unicorn as a section on Growth 91 is doing primarily, where you can keep your pitch in a standard structured format updated in real time. So whenever somebody approach or see it, they will see the live correct information, and the chances of getting the right connect or engagement further are very, very high. That's the fundamental basic value. Then naturally visibility pays in multiple ways. These are all bonuses.
Okay, sir, got it. Sir, there is some question in the chat box, and would love Vicky also opinions of Vicky also on this. So how to be careful to not to lose company control to investors over cap table as a founder, and maintain healthy equity and vote sharing.
Okay.
Vicky, you want to take it?
Yeah, that's what I was, in fact, I was going to ask you that, but anyways, I'll take that, Sanjay. Uh, this is exactly what I was saying. Technically, by law, there are two types of resolution. One is, I think, standard resolution as per company act, and one is special resolution that companies pass for doing various things, like even taking a debt, raising equity funding, or say a strategic alliance, or even an acquisition. These all depend on how much of it needs to have a majority. Like for example, for normal standard resolution, you need to have 51% majority of vote for passing a standard resolution, and for the other one, you need 76%, which is a special resolution. Special resolutions actually are like acquisitions and all of that. So you need to be very careful if you are actually, in your first round itself or first two rounds itself. Most of the, if all the founders together are actually losing more than 51%, it's a big risk for future growth, I would say. So you should be careful on that front. Of course, as you raise more and more rounds, this will dilute further. Of course, choosing the right investor is also very important, as Sanjay ji also mentioned. That few investors will come, which will be interested in your value creation, and a few will only be interested in the valuation. So my advice to, in fact, that has been an advice to all fellow entrepreneurs, you should focus on value creation and not valuation. Valuation and all of this will follow later on. So even choose the right investors who actually do not or want to actually see you grow rather than just make a quick buck and leave. So to answer the question, keep that in mind. Try and not dilute more than, I would say, 51%, at least in the first three rounds, or at least in the first couple of rounds. Not dilute more than 26%. That will help you keep more control. Of course, you should take advice from investors, but the final decision should be yours.
Got it. Okay, I think have answered the question. I'll move on to the first question. Actually, Sanjay sir, would love your opinion on this. So, founder has asked, I'm looking for raising funding, needing capital for building the product and hire the tech team. Should I consider an angel investor or a VC?
So, see, I mean, these are all just the theoretical terms. I mean, whoever gives you fund, please take it. So, even if it's a VC, I mean, they are a group of angel investors only, in principle, broadly, right? So, just don't go with a definition. Choose the right set of angel or right set of VC who you think have a good track record of helping founders and balancing between investor and founders' interest.
Got it. Sanjay sir would like to conclude here. So, thank you so much for joining. Any ending notes or tips for founders while building the product? Would love this from Vicky as well. I know your time is a little bit stretched, but would like to know one final piece of advice for entrepreneurs. So, Sanjay sir, starting off with you.
Sure,
Yeah. So, see,
sure.
basically,
Please go ahead.
as a founder, you are everything for the company, right? Unless you are passionate, committed, and 100% engaged with the business and having full skin in the game, and which is real and visible also, there is no future. So, I mean, if you ever think that, I mean, this is your part-time exercise as a founder, then probably, I mean, you are not a long race person and may not, the chances of survival or success are very less. So, whatever you decide, be 100% in it, committed to it. Second most important thing is, even if you take investors' money, consider this as your own money and spend it judiciously for the business. And that is very much important, especially when you take fund from external people. Third is always be ethical and be in integrity with the business. I mean, governance, although we say corporate governance is for large company, which is not true. Even if you are a very, very small company, your corporate governance standards, how you maintain, these are the things which will take you long way.
Thank you so
Maybe
much, sir.
I'll go next to questions.
Yeah,
And
yeah.
I completely agree with what Sanjay ji mentioned. Yes, no integrity and how to manage funds, all of that. Consider it yours is extremely important. I just like to add a few more. Like one is which I just said, a few minutes back also. Focus on value creation. Valuation will follow. I think most of the founders on this call might be in very early stages, might be just building the product, or the product might have been finding the first set of customers and all of that. But don't get into the valuation trap. So, very at the start, you should chase value creation. Value creation is where actually you created a product that makes life simple, reduces cost for someone, or increases productivity for someone. These are the things that you should clearly focus on, and not okay, no, today I will raise even something for 20 crore or 200 crore valuation, but finally it doesn't help you actually create value, then it is of no use. You'll actually end up no, either shutting down, or you might just hired, or like a hostile acquisition might also, so that's one advice I'll just like to add. One more thing is finding the right co-founders also. I've seen multiple people actually struggle. Either they are single founders, and or they end up finding getting a co-founder who is actually not a co-founder, more of an employee. This is what you should try and avoid. Find the person who has a very similar wavelength and kind of complements you. An engineer may should have more of a if there's a techie, then you should actually find someone who is more into sales as a perfect co-founder, rather than again two engineers doing it. Yeah, that's my advice. But of course, I'm not denying that two engineers will not build a great company. But find co-founders. Good co-founders are very important. And that's I've seen with many people struggle on that. And then you become a one-man company, or more of a self-employed guy rather than a business.
Got it. Thank you so much, Vicky and Sanjay sir, for joining in. It was great having your expertise. To founders, we are also having a presentation session, and I also have planned some giveaways for you, some knowledge session after this. So yeah, we'll be continuing with that. And thank you so much, Vicky and
Thanks, Uttar.
Sanjay sir, for joining in. And the time
Thanks,
got little
everyone.
bit stretched, but
Yep.
yeah,
And all the best,
we'll be.
guys. I'm available on LinkedIn. You can reach out to me. So just type in Vicky Jain, in case you need any further help. Happy to help. Thank you, everyone. Bye.
Yeah, thanks. So, yeah, guys. So that were Sanjay and Vicky. Will continue on the session. I'll just share my screen. I have some presentation prepared for you guys. I hope that is helpful. So, about me, I have now started three ventures. Have scaled three ventures, raised multiple grants as well. Have been posting about startups. Have got around 6.5 million impressions now. Now close to 20,000 followers and 20K community of founders. In this session, as planned, we will give away cap table template, ESOP scheme policy doc, and some shareholder agreement, founder vesting agreement, some investor red flags, and ESOP communication guide for teams. Like many times we have to communicate the team that this is the ESOP we are launching. So how to communicate and how to go ahead with that. We'll share a doc for it. So starting off, there are four pillars of a scalable startup. First is obviously your product, like what are you solving for? What is your usability, customer delight? And the second is marketing, like how are you marketing it? Is it just the digital marketing you are doing, or you are reaching out organically, doing some events, creating a community, and reaching out to them, right? So first is product. How good is the product? Like Mama Earth, if I take an example of Mama Earth, they created a good product first and they created a community of moms, right? So product was good, they created a community, and then when the investor comes in, they ask for equity and cap table, right? So who are the owners, who are the like brain behind the company, who are the backbone of the company, and that is where equity and cap table comes in. And the fourth parameter is team and capabilities, how you are going to hire more people and ensure a good execution of the product and all the execution plans that you have. So these are generally the four pillars of a scalable startups. Also, VC have a different checklist. So what makes a venture investor investable? First is obviously your business model, like how are you making money? Is your product selling and what price? How what are the margins you are having? How big is the market? Who are the founder and team members, how many founders are there, what is the background, what is the capital structure, and what is the exit potential they have, what are the pathways for liquidity, IPO, and secondary sales. Now let's start with cap tables. So what is a cap table? Cap tables tells us who owns how much of a company at any given time. right? It is the owners of the company. So cap table is equals to ownership percentages, right? Who owns what percent of the company. And generally, the ownership percentage is affected by the dilution, which happens in a funding round, right? So cap tables is equal to ownership percentages, which is affected by dilution, and funding rounds will also see it with an example. So anytime a dilution occurs, there is new shares which are issued, and the existing shareholders percentages decreases while the number of shares keep uh, uh, be the same. So let's take an example of ABC Private Limited. Manav is one co-founder and Aditya is one co-founder. Manav is having 50,000 share capital and Aditya is having 50,000. So the total share capital is 1 lakh rupees. Now the face value of shares is 10 rupees and Manav and Aditya each hold 5,000 shares if we divide it, right? And total shares are 10,000 and they both own 50% of the company. Now let's make a cap table for them. So this is the cap table. Investor is Manav and Aditya. They each have 5,000 shares, 50% stake, and share price now is 10 rupees, right? Now, after 1 year, let's say they do very good and ABC raises 1 crore of funding in exchange of 10% of ownership. Let's say Growth 91 is investing 1 CR into the company for 10%, right? So what will be the changes in the cap table? First, the existing shareholder, the percentage what Manav and Aditya hold will change. The total number of shares in the company will change because the new shares will be added up, right? Owners will not like the current number of owners will not dilute the share, but the new shares will be issued, right? And there will be a change in price per share. So when a company raises a round, founders don't sell their shares, new shares are issued, right? So Manav and Aditya collectively now hold 90% of the company. Before they were holding 100% because 10% is now going to Growth 91 as they are investing, right? Now 10,000 shares, if 90% equals to 90%, then X number of shares, 10%, we just cross multiply and get, we will issue now 1,111 shares, 11 new shares, right? So now the total number of shares is Manav has 5,000 shares, Aditya has 5,000 shares, and Growth 91 has 1,111 shares, which comes down to total of 11,111 shares, right? It is very easy and simple to understand. It is important for the founders to just understand all this because you have to personally go through and prepare cap tables at the initials, right? You will not hire a consultant, I assume, until you raise a pre-seed or seed round, right? So it is important for you to understand that every time dilution happens, new shares are issued and now 45% stake is with Manav and Aditya, and 10% will go to Growth 91. And how to carry out price per share, which is total valuation of the company divided by total shares, which is 9,000 per share. So this was the final calculation from my end. I know this type of calculation is a bit confusing and for founders. So this is a sample cap table. See, at the time of formation, only founders are holding equity, but as they go to pre-seed, there is an option pool as well, which is the ESOP pool, right? So ESOP pool is formed, then pre-seed investors also come in and take some percentage ownership. Then in seed stage, now seed investors will also come in, right? So it becomes more and more complex as you raise more rounds. So this is the ownership table after 5 rounds. You can see at the formation, it is very minimal. Now after 5 years it is a lot complex, right? So people have different tools as well which you can use to make your cap table. So this is the investor pitch life cycle, right? And how cap table is related to fundraising. So in the first step you introduce your idea to the investors. In the second step you have a detailed pitch with the investor. In the third step they have due diligence. So this is the most important parameter where cap tables, financials and everything gets checked, right? In the fourth step, you negotiate with the investor on percentages agreement and controlling rights and various other things. And in the fifth step, funds happen, right? Now let's talk about this step, which is due diligence, right? This is the most important step where your cap table and everything will be evaluated, your cap table, fundraising, and everything, right? What is due diligence? It is conducted by a third party to assess that the company is genuine and VC is ready to invest, right? So there are 202 items which are which gets checked, right? So it is very important for you to understand cap table and how to make it, right? Now, due diligence and key operations, there are three things which are checked. First is finance, second is legal, and third is human resource. In finance, the most important is financial statements. In human resource, it is the most important thing is cap table, right? Because who are the owners of the company will determine the future of the company, right? And financial statements will they will carry out all the ratios and what all growth matrix will be done, fund allocation and everything will be done. So these are majorly the three due diligence parameters: finance, legal, and HR. Now there are four types of uninvestable cap tables, right? So be cautious that we don't fall into this category, right? Now founders with insufficient equity. Let's say you dilute more than 20% in the pre-seed round, that becomes a uninvestable cap table, right? I want this is the most important slide. Like we should avoid all the mistakes that are here, right? Second is debt equity. Let's say you give 10% to an advisor, which said that I will bring you 100 B2B clients, right? But later he brings you zero, right? So it becomes a dead equity because now he's holding the stake as well and he's not contributing. So diluting more than 10% of non-contributing equity is a big red flag. Now, super veto investor. These are investors which hold generally 20, 25, 30% of the shares because they have right to do and implement anything they want in the company. So this is also a very big red flag for the you should avoid diluting more than 15, 10, 15% to any investor at the seed stage. Then this is also one of the cap tables where you dilute 50, like you give 5% equity to 10 different investors. Even if the investors are Anupam Mittal and right, Aman Gupta, this will not make sense because you have diluted majority of the stakes and you have lost your control over the company at a very initial stage. I'm talking about at the later stage. Obviously, you can do, dilute, right? So what are the common mistakes? There are unfair founder splits, like one founder gets more equity and does less work, right? So unfair founder splits is also one of them. Ignoring vesting clauses. So you should, in founders as well, you should have your vesting clauses, wherein if you are bringing in new founder, you should have a vesting period for both of you. Even if you if you leave in 1 year, you will get X number of shares. In 2 years, you'll get X number of shares. So it will aggregate to the 100% of the equity. And having no formal or legal contract, you should always follow all the legal and I know it is costly at the initial times, and if the startup is bootstrapped, it is taking a lot of time and money, but you should definitely follow all the legalities and all the formal contracts that are there because the chances of disputes are very high if we see overall failure percentage of startups. Then there are too many small investors, there is excessive dilution at the early stage, and there is no ESOP pool upfront. So you should always keep your ESOP pool in mind, right? You must have to allocate some equity to the employees or the contributors of the company because they are driving the actual growth, right? If everyone owns some percentage of equity in your company, then they will feel that they have to contribute, right? And stay with the company for a longer term. So that is the reason for ESOP. Generally, there are a lot of challenges with the founder equity splitting, like a lot of methods are there. Generally, the goal should be fairness, and if not done correctly, it can lead to dissatisfaction. Then there are different types of equity splits that are there, like static split is there, in which one founder, who brings in the money, leads and does all the holds majority of the stake, like 50, 60, 70%, and rest of it is left with founders. So sometimes what happens is, let's say your startup is a sprint and there is a 100-meter race, and your co-founder is saying that I can complete the 100 meters in 30 seconds. And when actually the race starts, he's not able to complete in 60 seconds as well, right? So this is a mismatch in the deliverables, right? So you should always be cautious of giving your equity right away. So that is why vesting and all other things are there. There is dynamic equity split, milestone-based equity split, wherein they complete certain milestones and you release the equity. And there is a hybrid approach as well, right? I'll not cover each in depth because already we have consumed a lot of time. So I'll just keep it very short. About cap table and equity, equity represents the ownership of the company. It is used as a currency to attract talent, financial investments. Then why is it important to increase the valuation, easy due diligence? These are the things that you should keep in mind. There are some types of equity instruments like there are common shares which are held by founders. There are common shares held by um, there are common shares held by just a sec. There are common shares which are held by founders, and these are the generally the equity shares. Then there comes preference shares. So preference shares are basically have their priority in liquidation. Then there are CCPS. So CCPS is a compulsorily convertible preference share, which is good for VCs and for founders as well because it protects the investor, and this will convert into equity in future, right? So there is no equity dilution immediately, right? And there are safe notes as well. So these are the different types of securities: equity and preference, convertible, redeemable, differential with differential voting rights. Like you have different voting rights in each, and there are safe agreements, warrants. Now, some things that investor want, like one is equity versus preference shares. Second is anti-dilution clause. Then liquidation preference they want in the company and some other rights as well. So now coming to employee stock option exchange, employee stock option ownership plan. So this is the benefits of it are you can attract top talent, retain and motivate employees, align interest with the founders, and preserve cash as you can offer equity upfront. Some there are types of ESOPs. So earlier, like we discussed the type of equity and the type of shares. Now, talking about ESOPs, there are share awards, so in which you give the equity upfront, right, to all the employees. Then there are standard ESOP plan, which generally has a vesting period of 4 years, wherein you give. First year is the cliff period where you don't give anything, but after the first year you give 25%, 25%, 25%, and 25%. So this is the standard ESOP plan. And then there are employee stock purchase schemes where ESPS, where you give an option to the employees that they can buy the shares at a discounted price, right? Then there are ESOP trust as well. Then there are registered stock units. So you give them a milestone that if the employee hits XYZ milestone, then you give certain amount of equity. So that is also an option with you. Otherwise, one more thing I've seen with founders they do is in the first year they give let's say 20%. In the second year they give 40%, and then like the equity increases with the number of years, right? So then there are phantom shares as well. Some of the key elements of ESOPs, it is a right to buy, not an obligation to buy, and it is given at a strike price. So let's see what a strike price is. And strike price is basically a predefined price. Employee earn this over a vesting period. I'll explain this with an example. So generally, what you gain out of the ESOPs is market price versus the strike price. If I can explain, strike price is the price at which you buy the shares. So let's say company issues you shares at a price of 10 rupees. So that will be your strike price, right? Because the price of the shares when the company issued to you was 10 rupees, and then there is a market price. Let's say the company made a lot of progress, and after 4 years, now the price of the share is 100 rupees, right? So difference between these two is gain per share, which is 90 rupees, 100 minus 10, right? And let's say if you are an employee and you have 100 ESOPs, then the investment would be like you have 1,000 shares and multiplied by 10, which is the strike price at which you receive the ESOPs. Now the investment is 10,000. And after 4 years, now the market value, which is 100 rupees, as we discussed earlier, Now the market value is 1 lakh. So wealth created would be 90,000, right? There is a ESOP journey. You first create a ESOP pool, then you approve a ESOP plan and get a board resolution. And then you grant, like you give the ESOPs to all the employees and advisors. Then there is a vesting period, so this, which is generally time based or performance based. This is generally cliff plus intervals, and there is exit and exercise. So yeah, that is it. Now open for the Q&A if you have any questions, and there is a feedback form as well. So if you can fill the feedback form, get the, you know, I'll get the feedback, and maybe next time we can improvise and bring you some more guests, and we can host some sessions at different topics as well. Would love your recommendation for it as well. So yeah, if you have any question, you can unmute yourself and ask directly.
Hi, Utkarsh.
Hi.
This is Vishal. Utkarsh, do you provide any kind of services also, or any kind of consultation supports and all these things?
So we have a platform called Growth 91, right? As I shown earlier as well, I'll just present my screen and show you. This is the platform we have for founders, right? This is the homepage, and here is the deals, like all the deals we are investing in. These are the 4 live investments that we are doing, right? One is into protein energy bar startup, then Good Melts, Extra Mile Play, which is employee engagement platform, then the Elephant. Now these are the completed deals that we have already done. Now there is a section called Future Unicorn, right? And if you onboard your startup here, then we will get this, your startup will get all the visibility to all the investors, stakeholders, customers, and everyone. And we keep on arranging these webinars as well, where we have some exclusive webinars. We have also planned some offline meets as well, so that can also be enabled through this platform.
This
Otherwise, you can
company,
also connect me on LinkedIn, and we can discuss how we can help you through this.
so this is based out of Bangalore, or like it is based on?
uh Vishal, it is based out of Ahmedabad.
Okay.
Yeah, also if anyone has any questions, you can unmute yourself, introduce what you are
Because,
doing, yeah,
uh,
what
uh,
your startup is doing, and then maybe ask the question so everyone knows, like, where you're coming from. Yeah.
Hi, Utas. I'm based out of Chennai.
Hi Kushal.
I forwarded our pitch deck.
Yeah, Suresh.
So,
Yeah.
yeah, myself, Suresh. We are based out of Chennai.
Uh-huh.
So, if I forward our pitch deck, can you help us for the investment equity base?
Sure. So, how, like, this is the Future Unicorn platform, and you can also upload your startup here. So we get all the details about the startup for evaluation as well, right?
Okay.
So that is how you can reach out and apply.
Okay, we'll
Otherwise, I
do.
have also given my mail into the chat
Yeah,
box. You
I
can also
forwarded
reach out.
just now. Yeah, I
Yeah.
got your email ID and I
Yeah.
forwarded just now. Maybe you have received the mail, I think so. You just check it out. Thank you.
Yeah. Got it. Sure.
No.
Hi, good evening, Utkarsh. This is Jairam here. Can you hear?
Yeah. Yeah. Hi, Jaga.
Hi, I'm Jairam from Cochin, and this is about the third event that I'm attending at Growth 91, and it's a fantastic event. This time is in fact the best one that I have attended. Of course, as many of the participants, they have also shared my feeling that we have actually, rushed through your presentation. It's absolutely fantastic. You had great interviews also today. Vicky Jain as well as uh, Sanjay Sir, they are absolutely fantastic. They explained from their side also. Uh, Suresh, can you please mute? Suresh, can you?
Suresh, your voice, actually, there is some background voice. Can you please mute yourself?
Suresh, please mute.
Sir, you can also mute them as you are host.
I'm trying. Just one second.
Thank you, the host. You've done a great job.
Yeah,
I hope I
yeah,
am muted, right? Okay. So
yeah. You can speak.
yeah. So what I was expressing is that, the slides, the slide deck, especially the sections that you covered, absolutely fantastic knowledge filled slides. Can you please make a arrangement for sharing this with our participants today, or maybe
Sure,
who
sure.
has contacted you, that's one thing. And the other thing is that, this feedback form. I am not actually having the link for the feedback form. The QR code is not getting read because of some light reflection or something. If it can be shared as a link in the chat, that will be fantastic, and I'll give you very detailed feedback on from my side. Yeah. Congratulations and best
Sure,
wishes. Yeah,
sure.
that's
Sharing in the chat.
Hey, of course, this is Venkatesh from Society. So I got a startup which is quite capital intensive in the beginning itself, because the way it is required to be launched, the product to be launched, it is significant capital intensive. So in that case, what sort of assistance is provided by Growth 91, and has there been similar cases in the past wherein valuation doesn't work in this case? Because valuation of larger size in the beginning is quite tough, though there is
Right.
valuation. So what's wherein Growth 91 help us in that?
So, Manas, we have, sorry, your name?
Oh, my name is Venkatesh.
Yeah, Venkatesh. So, Venkatesh, we have our SEBI registered Cat 1 Angel Fund, and we have now invested in 88 plus companies till now. So, are also looking for good deals. So, maybe if you can just come on our platform. There is a platform of Future Unicorn in the website itself. So you can fill out the form, and we'll get your details, your pitch deck, and your team and everything in the form already is covered. So we'll get all the details, and we'll get back to you.
Sounds good. Thanks. Appreciate it.
Yeah, yeah, sure. So, yeah, guys, I think, Manas, you have any questions? You can shoot it right now.
Yeah, hi. This is Manas. I'm from Bhubaneswar. Actually, I could not attend the full session. So if it is possible, somehow I can see it later on. But that is not my question. My question is, like I have been asking this to many people, but not getting any satisfactory answer. So my question
Uh-huh.
is like, I am a co-founder and working full time in my startup. Okay, there are two other co-founders who are not working. So what is happening is, like I wish to draw a salary from the startup, but we we are thinking that we will make it as a payable rather than like drawing the cash as and when, but we want to put it in on our papers as payable. So can I, change this to ESOP in a future stage as a
Uh,
founder and
And
director?
what percentage of shares have you given to the founders, co-founders?
Our structure is right now is like mine is 50%, and there are two more are there who are having 25%, 25%.
So I don't think it would make sense for you to, keep a ESOP pool of 50%, even if you are uh, converting the equity to ESOPs,
No,
it
no,
would not. Yeah.
no, that's not my question. My question is, I wish to draw a salary, which
Uh,
I'll put it as a payable, not draw the cash or the salary, the amount directly as of now, but later
uh,
on this amount, this payable amount, I wish to convert as a ESOP to myself.
okay. Okay. Yeah, that can be done. That can be done. You can
Okay.
obviously do that, and with the help of CA, you will be able to do that as well
Okay.
at the current valuation.
Okay, one follow-up question on that. Is it kind of what kind of impression it will create if we are going to future in some investors or something? Will it create a bad impression, or this is a common practice, or it is okay? I just wish to know your personal thoughts on this.
I think this is not a common practice. It will be a complex, it will become complex while calculating the cap table, because whenever ESOPs comes into the picture, and you are converting based on the past performances and past roles that you have done to the company, and now you are converting it into ESOPs. The investors would not like that, because right now they are investing at the current stage, and if you convert that, then I think that there can be some clashes, but there are investors as well who are open to this. I've seen founders doing this previously. I attended an accelerator program when one startup already have done this. So I think you can do it, but they face some clashes with the investors, but you can do it if the investor allows you to.
Okay, okay. Okay, then
Yeah.
I copied your email ID, and then I am first time attending this Growth 91 session. I'll check your sites and everything. I'll connect to you personally directly.
Sure, sure. Sure, guys. So I think we'll end the session there. Say thank you so much for attending, and would love your feedback. I've already shared the feedback form into the chat box. So next one we are going to arrange for how to pitch to venture capitalists, and hopefully we'll invite some more guests and some more speakers for the session. But yeah, so as we discussed, just keep in mind that equity is the real currency for startup, and always maintain a clean cap table, and a thoughtful ESOP plan should be the first priority that you should look into. If you are already planning to do it, then you should have a plan ready for it. And yes, a few check boxes that I shared into the PPT. I think that is it. And at Growth 91 and Future Unicorn, we enable visibility for the startup, and Growth 91 we have already invested as well. And Future Unicorn, we enable visibility of the startups to all the stakeholders. And I hope today's session gave you clarity on basics, and helped you some spot on some common mistakes to avoid, and left you with some practical ideas that you can apply in your business. So yeah, thank you so much for being here, and we look forward seeing many of you at our upcoming sessions. Have a great evening.